Last October was the 20th anniversary of Black Monday, October 19th, 1987. The Dow Jones Industrial Average dropped 508 points on one day, or 22.6%. Similarly, around the world, other stock markets dropped off. Hong Kong, 45%. Australia, 42%. UK, 26%. Canada, 22%. It was the end of a 5-year bull market. Many thought that it might trigger a depression. In fact, the fallout was relatively short-lived. It's also interesting to note that the causes of the crash are still debated today. Some believe it might have been the effects of computer trading or program trading. Others believe it might have been the interplay between the traditional stock markets and the growing and emerging futures and options markets. Some believe it could have been a lack of liquidity in the market to absorb the huge selling that was occurring. At the same time, the U.S. announced a significant budget and trade surplus, and many felt that would have a negative effect on share prices. And finally, at the same time, long-term bond yields were 10%, which was an inducement to move out of the stock market. So whether it was one or all of these issues, there was a significant downturn in the market. This January, we experienced another drop of the market. Not as dramatic as 1987, but nevertheless, the S&P dropped 10%, the Dow Jones 8%, and the NASDAQ 6%. And similarly, we had significant drops on global markets. Different from 1987, however, we know the causes this time. First of all, the fallout from the subprime mortgage market and the steep decline of U.S. housing prices. Secondly, a return to more rational credit pricing and the necessity of financial institutions to revalue their positions with regards to collateralized deposit obligations. This revaluation caused stock prices to drop in the financials and a knock-on effect to the rest of the market. And many at this time were looking to a recession, and this drop-off in stock prices fueled that speculation. Are there any lessons to be learned from these two market fallouts? Investors must learn that investing is a long-term project, no better illustrated by the Dow Jones in 1987 that stood at 1739, and today the Dow Jones stands at 12,450. Not a bad return, even given the ups and downs of the markets over the past 20 years. Markets are more global and more integrated than they were in 1987. And no market then is immune from a significant local event that has repercussions around the globe. But since 1987, central banks are more experienced and better coordinated, and thus better able to manage a significant crisis without experiencing a global financial meltdown. And unlike in 1987, there are many more markets today, and particularly the emerging markets like India and China, that have created huge pools of capital that have to be redeployed back into the marketplace. I think there are two reasons why this current market sell-off will be relatively short-lived. These offshore pools of capital must be redeployed and recycled back into the marketplace. Currently, the depressed values of U.S. assets present a tremendous buying opportunity for offshore money, either directly or through the stock market, and this recycling will stimulate market activity. Secondly, North American infrastructure is aging, and indeed some cases crumbling, and is in need of a massive capital injection to repair. This presents a wonderful opportunity for these offshore funds to participate in infrastructure rebuilding, and any companies participating in this business will reap the benefits as a result. And finally, and most importantly, as Warren Buffett says, invest in companies, not in markets.